The third great merger trend struck from the 1950s to the early 1970s. Many companies sought to combine horizontally with firms that were involved in the same business or vertically with suppliers or customers. However, a new wave of conglomerate mergers occurred as firms combined with companies in completely unrelated industries that enjoyed sales curves that ran countercyclical to one another.
In compliance with antitrust laws, most large firms are restricted from acquiring or merging with other companies within the same industry.
Firms seeking an acquisition could do so more easily across industries. However, executives discovered that the acquisition process could produce growth in the earnings per share of a company. They discovered too late that a bubble driven by conglomerate mergers would develop during the late 1960s. When the acquisitions stopped, someone got burned.
The conglomerate bubble proceeded like a chain letter. Such tactics worked for a while because investors in the 1960s tended to be more interested in steady, rapidly rising earnings and less concerned with how the sausage was made during a bubble that reeked of the public relations messages of promoters. However, the beginning of the end for the conglomerate bubble occurred when electronics producer, defense contractor Litton Industries announced lower than expected quarterly earnings in January 1968.
Next, the Federal Trade Commission launched an investigation of conglomerate mergers in July of that year. Market prices fell again. During this aftermath, the SEC and the Financial Accounting Standards Board called for clarification of reporting methods and standards for conglomerates.
This call triggered another large sell-off that resembled the collapse of the South Seas Company. In summary, let us review the characteristics of the conglomerate bubble. First, there were management difficulties in attempts to juggle diverse product lines. Secondly, the new financial math of conglomeration was far from transparent and led to expressions of viable concerns by regulators and other parties. Third, acquiring companies needed to have larger earning multiples than those firms in the shrinking supply of target companies. Fourth, conglomeration eventually resulted in lower earnings and flat price-to-earnings ratios. Fifth, in turn, lower earnings led to the shedding of unrelated, poor-performing acquisitions. Throughout the next few decades, a series of relatively minor bubbles occurred. However, the core of the conglomerate and other bubbles continued to follow a slow build, followed by a rapid ascent to an unsustainable peak before a sudden collapse.